The dividend described in B here is not a cash dividend, it's a property dividend. However, we're still going to look through and find those three dates that are going to become very important when we account for this property dividend, and that is the date of declaration, the date of record, and the date of payment, or the date of distribution in this case. So we have here stock that the organization owns in an outside organization, and happens to be Singer Company, and we own $900 million worth of common stock. So what the problem doesn't show us is the asset side of our balance sheet. We only have the equity section. The asset side would presumably have an asset called investment, and it would have a value in it of the book value or our historical cost, in this case, which is $900 million, and that represents the 120 million shares of Singer Company. So when the organization here, Canned Food Inc., declares the dividend on March 5th, we have to first look at whether this book value is the current market value or not, and second, determine how much of our retained earnings amount is now restricted or obligated to be paid into the future. So a journal entry does certainly occur or need to be recorded on March 5th in this case, because that's the date of declaration. And we could follow this last transaction and say we're going to debit retained earnings, but we're not sure yet for how much. Actually we are, but we're going to come back to this first part of the entry, which would say, okay, debit retained earnings, and we would credit this thing called a property dividend payable. Instead of a cash dividend payable, it's a property dividend payable. But the first thing we have to do when we are declaring a property dividend is look to see whether the market value of the stock we're distributing has changed relative to our book value, and it has. If we look at the value on the books, is 900 million, so if you took the $900 million book value and divided by the 120 million shares, that indicates the shares had a purchase price of $7.50 per share, and they've increased to $8 per share. So if you take $8 per share times 120 million, the current value is now 960 million when we declare the dividend. And that's significant because on the date of declaration we have to mark to market the value of the investment. So no longer should it be carried at 900 million, it should be carried at 960 million, which represents the market value on the date of the declaration of the property dividend. So we have to increase this investment, so I could debit investment for $60 million, and I would credit that value went up, so the question is, where does that go? And that's actually a gain. It's a gain on appreciation of the investment, and we have to recognize that gain. So we had a $60 million that would flow through to our income statement as ordinary income. So first we mark to market, so now we have the asset in the balance sheet correctly represented. And the second thing you do is on the date of declaration. Remember, that's significant because it shows that the organization, the board of directors, has committed to the shareholders a distribution of their profit, not in cash, but in varying form of payment, which is the stock of Singer Company. So we're going to debit retained earnings for the value of the entire stock, that the market value that we're now going to remove. We're not going to give it out yet, but we're going to create a liability account called the property dividend payable. The date of record, there's still no entry. And lastly, the date of payment, or the date of distribution, and in this case that happens on March 30th of 2016. We simply remove this property dividend payable for the full amount that we've recorded here, which is $960. And you aren't going to pay out any cash. We actually are going to distribute the investment. So this, the value of this investment, the entire $960, would be removed from the asset section of our balance sheet. So those are the entries to record the transaction listed in B here.